Guys, one-to-one risk reward fixed my trading. And this video is probably not going to be what you think it is. I'm going to show you why you need to trade one-to-one risk reward initially to become a profitable trader. Now the textbooks and most trading literature will say otherwise, but I only found profitability once I started trading at one-to-one. And I get all my new students to do the exact same thing for their first 3 months. The result is the majority find profitability in that time.
Everybody gets into trading for the same reason, to make money. And that's fine. Ultimately, that is the reason why we start trading in the first place. But unfortunately, this is counterintuitive to helping you achieve your goals because you instantly expect results as a trader before actually going through the process of becoming a trader. And the most important thing you can do as a trader is start with the process. Everybody starts with the outcome. They want the money, they try to optimize their strategy, they watch a million YouTube videos, they jump from mentor to mentor, Discord group to Discord group, trying to figure out what the holy grail is, what the optimal strategy is. But the reality is you need to start with the process before you even think about the strategy. And this is completely counterintuitive because as a trader, our goal is to make money. But if we don't have a process in place to make money, to get to that end goal, then we're naturally already trying to achieve the outcome without the required process. So the most important thing you can do as a new trader, or even as a trader if you're unprofitable and you've been at this game for ages, is build data. And I collect data still now on every one of my trades because my goal is to continuously optimize my strategy. And all you need to concern yourself with is building enough data on your trading edge or your strategy to figure out how you can optimize it. Is it even profitable? Can you make it more profitable? Can we improve the parameters we're using? Is there a certain type of trade that we should or shouldn't be taking? Are we better trading with trend, counter trend? Are we better trading certain assets at certain times? You don't know any of this stuff until you've built the data. Now I get my new traders to fill out this, which is 100 trades worth of data. And you can see here I've got 164 entries in this journal. It's 164 pieces of information that tell me exactly what I need to do. But you can see throughout here that R gained was either 1 lost or 1 gained. It was a one-to-one risk reward that I traded. I never traded more than that. And the simple reason is because my goal wasn't to make money through here. My only goal was just simply to figure out what works, what doesn't, and how I can optimize it. Once you have some really basic pieces of data, like the win rate of the edge, the session time that you're trading best in, the instruments that you're most profitable on, you can move on to a more advanced and comprehensive form of data collection. And that comes even as a profitable trader. I do this with every single trade I take. For example, I trade supply and demand. Very, very simple concepts. Maybe you trade New York Open. You might trade a more complex edge around Asia, liquidity sweeps, and so on. For me, it's very, very simple. It's supply and demand. And I use cross-asset alignment. And cross-asset alignment just simply shows me that the whole market is ready to react to a zone of supply or demand as opposed to just one instrument. I'm trying to look at the market as one entity as opposed to individual instruments, right? And I start to look at things like the distance to the first H1 area of supply or demand. How far away was it? Did we achieve it? Did we get to the first H4 supply and demand? What type of supply or demand level was more likely to reach a certain type of H4 supply and demand? Was there a risk move? Was the S&P 500 moving? Was the bond market moving? Was that inadvertently affecting currency, gold, the assets that I trade? Was it the last leg of structure? Something else you can track is, was it with trend? Was it counter trend? And you start to see these patterns develop, and those patterns enable you to understand where your edge is in the market. They give you so much information that you no longer feel lost when you look at a chart. You simply turn up, you execute what your data has told you to execute. Then the next thing you need to do is reverse engineer what the goal is. So no doubt your goal is a monetary one. And if your goal is something as specific as like $100,000 prop firm payout, that's something you want to achieve over the next 12, 24 months, whatever, right? Then you need to figure out how do I get there based on the information that I've got with my current system. Now you've built data on 100, 150, 200 trades. That's telling you enough information that you have an edge in the market and you know exactly what you need to do every single day. But you also need to spend time optimizing it. You need to make sure your edge is as efficient as it can be. What's your average drawdown per trade? Are you using the best parameters? Yes, we traded at one-to-one and we built all the data on one-to-one, and we can see we've got an edge at one-to-one. You know, there was a 77% win rate at one-to-one risk reward there. That's an edge. But can we make it even better? Are we better trading at 1 to 1.25, 1 to 1.5? We'll only know that through our data, and our data will allow us to optimize our edge to perform even better. It then becomes much easier to reverse engineer towards your goal of $100,000 of prop firm payouts, because you know the exact expectancy of your system month on month. And it's not until you've built this data that you can really start looking at your risk reward. Your risk reward becomes really important when you start to understand what your max consecutive losses are and what your goal is. If you don't know what your goal is, then you can't reverse engineer it. And you don't know how to position size in the markets because you have to understand what your max consecutive losses could be. Now, if let's say you have a 35% win rate at 1 to 3 risk reward, hugely profitable system. A lot of traders trade with systems very similar to this. They have to understand that through 20,000 simulations over 100 trades, the average consecutive losses was 9.13. Now, if you're trading, for example, on a prop firm with an 8% drawdown limit, then the likelihood is you're going to hit that over 100 trades. Maybe you're going to fail a couple of challenges over 100 trades. But it's all about understanding what your goal is. Now, if you have a method with prop firms where you recycle accounts, for example, you trade one account on a Monday, then you trade another account on a Tuesday, and you recycle through your prop firms, how does that affect your max consecutive losses? How does that affect your likelihood to pass, to get payouts? It will massively increase it, but you won't know this unless you have data, and data will answer every question that you have about your edge, about how to earn and how to get paid as a trader, and also what sort of drawdowns are normal for you. When you hit 6 losses in a row, do you start to strategy hop and deviate, or do you feel comfortable with that because you have your data and you know that your system averages 9 losses in a row? So something my data told me last year was that if I'm going to trade the lower time frames, for example, the 4 hour, the hourly, then I need to be with the daily trend. If I'm with the daily trend, I have a much higher win rate. And this gold long that I took last week as it pushed into this clear area of demand was with the daily trend. So I had high conviction. I know the win rate of these is above 75%. And I also know that I can usually push the risk reward over 1.5R. What about counter trend? Well, I have to wait for the daily, the 4 hour or the 1 hour to really overextend to start to create distance between the moving average and the current price. When we create these distances, we tend to revert. And they're the areas that I'm potentially looking to go counter trend, but not before that. And I wouldn't know any of that if it wasn't for my data. Last year, I wanted to see whether I was more profitable from a discretionary standpoint with trend or against trend. I'd determine what the trend was on the daily and the 4 hour. If I was with the trend, I recognized that my win rate was about 10% higher. If I was with the trend, I recognized that's where my win rate was the highest. If I was counter trend, I also recognized that I could really push the R if the market was heavily overextended. And again, that was all based on data, not just watching random YouTube videos, going on social media looking up strategies, or spending half an hour backtesting. I'm building data on hundreds of trades to understand where my edge lies in the market. And yeah, I'm not the best trader in the world, but I have a system, it's profitable, it makes money, and I understand how to optimize it. I think that's all trading ultimately is. I also know through my data that if I take a trade with cross-asset alignment, I again have a higher win rate. If I take levels individually on instruments without any cross-asset alignment, without understanding why the move is happening and where it's coming from, then my win rate reduces. So like with this silver level here, as it pushed into the area of demand, platinum was also pushing into an area of demand, and it was a metals move. By stacking those instruments together, we increase the odds of the trade working. If you want more information on cross-asset alignment, just go under this video and download my free PDF. It's all explained in there. So before you consider what your risk reward needs to be, you have to build some data and just start at 1-to-1. It really doesn't matter whether you use a 20 pip stop with a 20 pip target on every single trade or a 50 pip stop and a 50 pip target. But you have to at least look at your missed potential on every trade and your drawdown. Now this could be called your max favorable excursion and your max adverse excursion. But you have to measure it and you have to work out, are my parameters optimal at 1-to-1? Could I push for 1-to-2? Am I better trading at a 35% win rate at 1-to-3, 1-to-4, 1-to-5? That way you're going to understand what your consecutive losses could be. You also know what your expectancy should be over 6 months, 12 months. But as well as all that, it will give you an idea exactly how to position size according to the goal you want to achieve. Is your goal to make as much money as possible on a fund over 12 months? Or is your goal just to get as many prop firm payouts through gamification as possible? Your data will tell you exactly how to do it.